Selecting the right tools within an investment portfolio to meet different objectives is the quest of every responsible saver. But the debate whether to use passive strategies or active strategies or both continues to rage on. Most wealth managers argue that there is a space for both in something called a satellite approach. Sean Latter from Questa Wealth is still in studio with us to weigh in on the subject. Sean, I've got myself stuck in the middle of this debate a couple of times, and I've seen the merits of both, using passive strategies via ETFs versus using a very outstanding investment manager. Both have their advantages and disadvantages. I wanted to get your opinion on what you do with your clients' money in terms of using the two different classes of investments.
Well, yeah, I mean, what I find interesting and sort of quite hopeful is that we're starting to see that the debate is changing slightly. So we know that for the last 40 years, the active versus passive debate hasn't been solved, and I don't think it will be solved. For the simple reason, I do believe there's space for both. And I think when one looks at it, again, you can't apply a blanket approach. So I know many people looking at the core satellite approach have looked at it as a 70-30 split or an 80-20 split or whatever the case may be. The bottom line is we've run a number of sort of analyses on this, and we've actually spoken to a lot of fund managers around it as well and asked them to run some numbers for us as well. And what we've found is there's no magic number to it. So anyone who's using the 70-30 or 80-20 type split, it's sort of an appreciative kind of quid pro quo type thing when they're saying, well, balance of all odds, we're probably right. What we do and how we approach it is to have a look at it and say, when we're looking at passive strategies, where we see it working incredibly well is, like it has been intimated, a core of a portfolio, and more specifically when we look at multi-asset class. So one of the areas I believe that an active manager cannot add a huge amount of value is when you've got a multi-asset class return target type objective, which is what every investor needs.
And why is that, Sean?
Because at the end of the day, if we look at those that have managed to outperform, they're specialists. Okay, so they're either an equity specialist or a property specialist or a bond specialist.
Right.
Okay, so when having a look at that, you can say, well, number one, to get a manager who's going to be able to blend all of those together and still come up trumps in all of those different asset classes, I don't believe is plausible. If one looks at it and starts having a multi-manager type approach or fund-of-fund approach, the challenge you have there is costs. Okay, so either or, you're having those returns eroded. So from a multi-asset class point of view, we rather have a look at it from a passive perspective and say, we're going to secure the lifetime assets of our clients. In other words, all the income that you need to generate for yourself for this lifetime, we're going to ring fence the capital for that, and we use a passive multi-asset class strategy for that. Anything over and above that is deemed to be surplus. In other words, it's money that you're unlikely to spend in your lifetime. With that, we can start bringing in the likes of active managers where you can put together a high conviction, highly focused portfolio that I believe will give you alpha or excess return in the long run.
Sean, the argument now is that choosing a passive strategy is an active choice.
Yes.
We do research right around exchange-traded funds. I think just in the broad equity market category now, you've got a variety of different strategies. You've got the top 40 strategy. I think there's a couple products there. You've got the SWIX strategy, which is the shareholder weighted index. You've got the equally weighted index by Nedbank. So how do you think about just choosing the right passive strategy to give you broad market exposure?
Yeah. Personally, we look at SWIX. Okay, for the pure reason that I think if we look at the market as a whole, we know that it's going to be overweight in resources, and in certain circumstances it's going to become more overweight in larger, more expensive stocks. That's the first side of it. So we look at SWIX. But I mean, you raise an interesting point, and this is where the passive funds become more and more like active funds, because there's different overlays, there's different analyses that are being brought into it. RAFI is another prime example. I'm very hesitant towards those, and part of the reason that I like passive and I like the sort of straight vanilla ETF is that that's what's tried and trusted, that's what's proven, and that's what we're basing our return targets on. is on a market that we understand, and it's on a market that is delivered in a certain range over a period of time. As soon as we start bringing any other variables to the party, the predictability of passive investing starts falling out the window. And like you said, it starts becoming active. If we have a look, I was just looking at the Satrix funds the other day, and over the last 3 years, because people say they love Satrix, over the last 3 years, you've got a range of returns of between just over 25%, I think it's 25.14%, and 2.5%. So there's a huge variable in terms of what they're looking at there. And so one has to be very careful in terms of saying, if I'm going to go passive, what am I going into passive for? Am I going for some level of certainty and predictability? If so, then I need to go as close to the market as possible. If I believe I'm going to make an active choice on a sector or on a style of passive investing, then it's going to be a different story altogether.
So you take a very simple approach. You use broad market ETFs with none of the fancy research or value biases that you can buy with now. I think, and I include the Absa's probably just brought out that momentum. So you stay away from all that kind of thing, and you use the passive strategies as the core.
That's right. Yeah. So we use passive as a core, and then once you look outside of that, so we're the first ones to say when we have a look at passive, there's a couple of chinks in the armor. The first one, which I sort of alluded to earlier, is that it is going to have a heavier or higher exposure to the larger and more expensive stocks. Okay, so that's a chink that we need to look at. To counter that, when we look at the surplus asset side of things, we're going to say, if we're going to have an active equity mandate, it can't do the same as what my passive fund is doing. It's got to be doing something different. So what we start having a look at there is to start say, let's have a look at deep value, in other words, sort of really unloved and cheap stocks, and let's look more towards the mid to small cap zone. So you're actually taking the focus away from what your passive's trying to achieve, and you're saying, now we're going to start digging into the market where volatility is not as much of an issue because I'm not drawing an income from it, and alpha creation is the key focus, and that's where we apply the active.
And the $1 million question now is how do you choose those investment managers? Because this is a subject that has, I think, tons and tons of academic research behind it. Something I try and look at and do is try and evaluate fund managers. What's your sort of rule of thumb for selecting that real alpha generator?
Firstly, I think we know that past performance, or even what they might deem as a track record, it's not reliable. It can give you some guidance, but I don't think it's reliable enough to make a firm decision on. What I look at within my business is, do they have an investment philosophy, an investment process that resonates with me? And are they going to stick to that on almost a die-hard approach? So what I don't want to have in an investment manager is someone who's going to sort of drift with the wind and, you know, go from a value bias to more of a momentum style to a growth, you know, and that to me makes me nervous. I want somebody who says, this is our investment philosophy, this is what we believe, this is the process that underpins it, because I think behavioral risks are huge from a professional manager point of view. That then resonates with me. I will take that manager on, not for their track record, but because of their philosophy, because of that process. The other side of it, when I sit down with my clients, that's what I talk about. I talk about the process and philosophy. And it's very simple. It either resonates with them as well, or it doesn't. So I'm not trying to sell a fund manager. I'm more selling the philosophy and process.
We talked a little bit off air about Regulation 28 and a little bit earlier in the show about some of the adjustments that have been made through Regulation 28. One of those is allowing alternative investments a greater allocation within a pension fund, a provident fund. Is there space? Do you believe there's a role for alternative investments in your clients' portfolios, in a person's portfolio?
Do I think there's in an investment portfolio? Yes. I would look at it more from the avenue of the surplus asset as opposed to lifetime asset. When looking at an alternative investment strategy, you know, my thinking on it is simple: is that, you know, it's hard enough to get the long calls right. It's near impossible to my mind to get the long and short-term calls right consistently. So, you know, in the alternative investment strategy space, from a pension fund point of view, or any retirement funding assets that I look at, I wouldn't regard it in the portfolio. having a look at surplus assets, absolutely. I think there is scope for those types of instruments, and to get sort of a couple of the more exciting type prospects out there. That's where it would fit in for me.
Okay, so just to recap there, so if I'm getting this right, you've broken up your clients' portfolios into lifetime assets, which are assets that need to generate an income at some stage to support the investors.
Yep.
And then you have the non-core, which you really use in active strategies then, and could possibly incorporate very deep value investments and specialist equity managers.
Mm-hmm.
And you're looking for strategies that really resonate with you and that your clients can understand too.
Absolutely, yeah. So for me, it's all about value style is very much something that resonates with me, and I'll work with a manager that is going to live and die by those philosophies, and once again not get swayed by sort of emotions or sort of murmurings in the market, but rather say, let me apply the principles of value investing, let me stick to it, because I know in the long term it is going to provide the alpha that we need.